Hey everybody, this is Brant. Thanks for joining me. I got a lot to cover in this video, a lot of interesting things. So first, let's pick up where we left off with last weekend's video. I said that the market was losing downside momentum, that it was deeply oversold. I wouldn't be entering new shorts down in this area where it's really oversold, but I would be managing, shorts that we do have on from higher levels. I showed a few head and shoulders tops that hadn't broken yet. I thought some of those would break this week, and others that have already broken would start to see a little bit of a back test. By the way, this is the neckline for the S&P 500's head and shoulders, so it's just below it. This is kind of like a little back test. So we'll review those. What's really weighing on the market ever since the FOMC, the Fed, in the middle of the month, has been yields at the long end are just going nuts. So the 10-year yield was up 13 basis points this week, the 30-year up 19 basis points this week. So we ended the quarter Friday with a mixed market, which is actually pretty good considering that kind of a rise in long-term yields. S&P 500 down 0.75%, Dow down a little bit more than 1.25%, NASDAQ ended up 0.1%, and small caps were basically unchanged, up 0.5%. All that movement in yields has been at the long end, so we have curve steepening, which is important as far as recession timing goes, and we'll get into that in this video. So real quick, here's where we come into the week. Bear flags, right, still, so we have a negative bias. I think semiconductors were even leading lower, so it was obvious we're going to have a little bit more downside. By Wednesday over here, we got a bottom and a little bit of a bounce. Let me move to a 5-minute chart here. And what you can see with the S&P is this 4,300 level has been really tough. You can see it on Friday right here at the close, like trying to get above it, but not. Let's take a look at the head and shoulder patterns. Okay, so here's the S&P 500. You can see up here 2-hour chart. Here's the head and shoulders top. We came into the week right about there and kind of broke that decisively, and we got like a little bit of a back test up towards that neckline. If we look at SPY and use some volume here, what you'll see, let me pull up the volume, is exactly what you should see in a head and shoulders top. And what you see is on the rally up here to make the head, you see volume falling off, and then volume on this right side of the pattern is increasing. And if we look real close, what you'll see is as price breaks the neckline here, the volume increases, which is exactly what you should see at head and shoulders top. I want to point out one other thing real quick too, is this heavier volume right here when we make a low in the middle of the week. That means it's more likely to be a short-term low, and it's kind of like a little hammer candlestick on this 4-hour chart. But notice the heavier volume, that's typical of the end of the quarter. Here's the 2-hour chart for the NASDAQ 100. It had ended last week right at the neckline, so broke below, and this is what we're looking for, the neckline to act as a speed bump and price to kind of linger around that a little bit. So we see that there in the NASDAQ 100. Here's IWM small cap, same thing, another head and shoulders here, breaks down below it, a little bit uglier. And let me just pull up volume and show you what's going on here. And again, what happens on the left side of this doesn't matter much. So we see, a market over here that's rallying on some heavier volume, that's fine. But as we get into this rally, look what's happening to volume. It's just falling off. And then as we get to the right side of the pattern, we get red volume that's picking up a little bit more. And if we zoom in real close, look at the break, the decisive break of the neckline here and that heavy volume. So this is absolutely typical of head and shoulders, and it is probably the most important thing that you need to look for in confirming a head and shoulders rather than just a random price pattern that looks like it, the volume confirmation. Let's take a look at a couple sectors real quick. Really lightly weighted materials, not influential at all, but head and shoulders here, breaks down, pretty decisive break on that. Last weekend, I talked about the financial sector, which is not a head and shoulders top, but rather a descending triangle, which is bearish as well. Actually, most head and shoulders have a descending triangle as well, because that would be the head, this would be the right shoulder. So it broke down. There's an example of a back test into that neckline. Let me pull up the industrial sector. It's got kind of a odd shaped head and shoulders, but still kind of almost like a double-decker bus, but it's broken down, kind of back tested into that neckline. You might remember last week I said the tech sector had not quite made it down to this neckline yet, but semis were leading lower as we came into this past week. Well, now it has, and it's acting as a speed bump, just like we're looking for. I think consumer discretionary, another mega cap heavy sector, hadn't broken at that point. Now it's broken too. So we have that, and the communication sector, which is now at, this is kind of a funky shaped one, but still same thing. We got the lower high over here, right down to the neckline. In communications, another mega cap heavy sector. And speaking of mega caps, here is MGK, the mega cap growth index, or ETF. Head and shoulders again. So if you look at the S&P 500 on the year to date so far, it's been the Magnificent Seven, or the mega caps, that have carried the market. That was our call in December as we were coming into the new year, that the mega caps would lead. They were the most hated stocks of 2022's bear market. If you look at the S&P 500, the benchmark weighted index, where they have a lot of weight, it's up almost 12% year to date. If you look at the S&P equal weighted index that strips out that mega cap weight, guess where it is? It's completely unchanged on the year. So that's how much juice 7 stocks have contributed to this market rally in 2023. One of the things that really, actually I was seeing head and shoulders, or potential for head and shoulders, before we got to the head. But one of the things that really set it off for me was a key reversal day. Now, that key reversal day came right after a Fed rate hike. I'm going to tell you a little bit more about that. But I want to show you a key reversal day, this one and one in the past. They're really, really strong daily candle signals, very important ones. So this is a daily chart, the S&P 500. Here's our October lows. Here's the rally ever since. Here's the head and shoulders that's forming. What I want to point out is right at the top of this head and shoulders, this big red candle right there is a key reversal day. I'm going to zoom into it, and you can see it here. So it opens at a new high for the year, and then it closes well below the whole entire previous day's range. That's a key reversal day. Very important. It's right there at the top of the head and shoulders, right the day after the Fed put in what I think was their last rate hike in July. Now I'm going to show you another one of these that capped off also a high for the market and led into a really nasty, well, you'll see. So I'm using the SPY here because the SPY shows a little bit better, but this is rolled back to October 2007, okay? This was the all-time high. That's a key reversal day, just like you just saw in the S&P 500 this year in July. And if you know anything about 2007, October 2007, that was the all-time high. And from there, we just moved into 2008, and then the financial crisis coming up here. And it's coming. And if we kind of zoom back on all of this, started with that key reversal day right there, and that's the financial crisis. So they are very important. With ours now, look where it happened too, 4,600, which I had been saying for months before this. This is going to be an absolutely key level, 4,600, and it was right there. So traded above it intraday just a little bit and then sold off hard. The member subscriber post that I put out publicly for free, you can find it at Wolf on Wall Street Trade, or you can find it at technicaltake.net, is about rates, and something I saw that just terrified me, still terrifies me. Not for the market, because I don't mind shorting the market. I think you can make money a lot faster because stocks fall a lot faster and harder than they rise. But for the economy, for my friends, for my family. So I had been talking about this for a week or two before this. I'm going to show you a post that was for members on Monday night. Okay, so this is my daily wrap post Monday night of this past week, and what you're looking at is the 10-year yield, bullish triangle here, big bullish flag over here. And as of that point on Monday, it was the highest close, or highest closing rates in 10-year yield since October 2007. What did we just look at that happened in October 2007? The key reversal day. But that's not the point. It's highlighted down here. If you're a subscriber of mine, you know my work, you know that all my opinions are based in something that I can back them up with, a chart. It's not like, well, I just think this is going to happen. I give you objective evidence as to why. I do want to say that my opinion of this, not based on the chart, my opinion of this is, we're going to get into a recession and then yields are going to come down. But based on what I see on the chart, while I have had a hard time imagining it, the measured move from this bull flag over here comes in around 6.6% for the 10-year yield. The very next morning, I mean, you cannot make this stuff up. The very next morning, here is the post for the AM update before the market opened. And just focus on what's highlighted here. JP Morgan Chase CEO Jamie Dimon said that the world may not be ready for interest rates to reach 7%, according to the Times of India. I was just talking about this the night before. Like, I can't imagine that, we're going to hit 6.6 in the 10-year yield, close enough, 7%. But that's what the chart's saying. And Jamie Dimon, not that I have a lot of respect for JP Morgan, but obviously they've got somebody reading charts too that's seeing the same thing. This is the CEO of JP Morgan. So now we're looking at a daily chart of the 10-year yield. Like I said before, we had a very nice bullish triangle right here, ascending triangle, right? Breakout, huge bull flag. And this is something else I talk about frequently, is that all the concepts that I use and that I teach are fractal. So a bull flag, if you understand what it is, how it should look, how it acts, what happens next, you can apply this to 10-year yield. You can apply it to the S&P 500. You can apply it to Bitcoin. You can apply it to a daily chart. You can apply it to a 1-minute chart. But what I really want to get into is just the extent of the measured move that comes off of this. We're talking about 6.6%. Jamie Dimon saying 7, I think we're close enough, but 6.6%, we're up here. And the 30-year yield, like I said, since the Fed last week, yields at the long end have just been blowing out. So here's the daily chart for the 30-year yield. Do you recognize this pattern? We just saw it on the 10-year back here, a bullish ascending triangle. It has broken out, and if we go with the measured move here, that takes the 30-year yield up to 6.7%. It's at 4.71 right now. That's like another 200 basis points. That would be catastrophic for the market. It would be catastrophic for the economy. And I'm already in the camp 99%. We're heading towards a deep recession. That was before I was seeing these and really kind of freaking out about it. So that's what that post is about. Check it out. That begs the question to me, are we about to see a secular change in rates from deflationary to inflationary? This is a chart I've shown many times in my videos. My subscribers probably know it. The 10-year yield traveling in this channel. If we take it back a little bit more, you can see this is the fight against inflation. When inflation peaked and Volcker took the Fed funds rate up to almost 20%. And then it's just been on this long-term 4-decade secular downtrend or secular bear market for rates. But what I've always pointed out with this was that when we were down at the bottom of this channel, a new bull market was starting. But when we were at the top of this channel, like over here in 1987, that's when we had the Black Friday crash. If we come into like 2000, that's the dot-com bubble bursting right there. So every time we move to the top of this channel, it's been a market bursting. There's the top of the channel, and that's August 2007, so right before the market topped, rolled over, went to the financial crisis. Then we saw this little peak above in 2018. The market crashed again. S&P sold off 20% between October and December of that year. And this is the new inflationary trend. You see this whole 40-year trend is changing. That begs to me the question, are we headed for a much more inflationary secular trend, like this secular downtrend in rates or deflationary has perhaps ended? I don't know. Interesting question. That would flip everything, like everything that people have loved to buy over the last 20, 30 years and have hated would just flip on its head. The whole market would change completely. So that's probably a nice segue into the next thing I want to cover, recession. Like I said, I'm in the camp, 99.5% recession is coming. I've talked a lot in the last 6 months or so about the lagged effect of rate hikes. The Fed hikes the rates at their meeting and it's instant, right? But the economy doesn't feel it. And I've been saying, in my experience, it's about 12 months. The economy doesn't feel a rate hike for 12 months. Since 1981, recessions have started between 8 and 17 months after the last Fed rate hike, which was July. And if you average that out, it's 11 months, right? But I do want to show you one other thing. I always talk about the inverted yield curve being a predictor of recession. It's been accurate every single time since World War II. But after that inversion of the yield curve, it's the sharp steepening right before that tells you a recession is imminent. these rates that have been jumping at the long end, that is steepening the curve. So what I want to show you now, this is a chart I saw from Tom McClellan this week, and he just makes the point perfectly. So here's the yield curve over here. When it dips below this black line, that's inversion, right? And you can see real GDP. So these are recessions below on this histogram. But what he's done is something pretty smart. I wish I had the charting skills to do this, was he offset this by 15 months, right? So he pulled the curve forward by 15 months. And what he's showing, I've been saying about 12 months, that we see a recession after the curve inverts. And what he's showing by pulling this curve forward is 15 months after inversion, recession, 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 double dip, recession, 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 recession. So he's using the 3-month 10-year spread on this, which is the Fed's favored yield curve for predicting recessions. And it inverted October of 2022. The 2s 10s is just as accurate, and they inverted July of 2022. So that suggests, if you use that 15-month move forward on it, I've been saying about 12, but that's kind of an estimate. That suggests a recession starting in Q4 2023 or the first half of 2024 next year. And I don't think it's just going to be a recession. It's not just that the Fed is hiked and that rates are higher and all that in the inverted yield curve. It's how much they've hiked, how fast they've hiked. Every time the Fed does that, something breaks. We saw a little flash of that with the regional banks in March of this year, but I think we're going to see something major break. So what you might want to do is just pause the video on this chart and you can take a look at it. But what it shows is the Fed funds rate in blue, and these are like really sharp rate hiking cycles, right? Here's our most recent one. And then in gray, you have recession shading, and then you can see the actual crises from these really sharp rate hikes. So you got 1987, you got the S&L crisis over here, you've got long-term capital management failure, the dot-com bubble, the financial crisis over here. Look at the rate hike cycle here, how fast and steep it is, again, over here. So I think we're going to have, like we historically have always had, a crisis, some kind of crisis above and beyond a recession. This next info bit is kind of random, but I like to throw stuff out there every once in a while. I throw something different to mix it up. And this is a 4-week moving average of U.S. bankruptcy filings in green. Okay, so the last time we saw them at this level was when they shut down the economy, COVID lockdown, right, in 2020. And we're nearly at the same level as the financial crisis. So this is what I'm talking about, that lagged effect of rate hikes. It doesn't happen instantaneously. It takes a little time. People, have higher bills. They have higher credit card payments. They miss them. They have to declare bankruptcy. That's the lagged effect. So now let's talk about what we expect maybe going into next week. Started this past week off, bear flags, ugliness, and found a low. Remember, high volume low there. That makes it a little bit more probable that it is a short-term low. There's that neckline. We're looking for back tests, even a little bounce above that for tactical short positioning. So let me go a few charts. First, very, very low conviction this past week by the bulls. So this is a 3C chart of SPY. 3C is my proprietary money flow indicator. So if everything is as normal as it should be, and there's no accumulation or distribution under the surface, 3C should track with price. You can see over here, mid-September here, that as prices were moving up over here, 3C was showing selling into it, and prices followed that divergence. So what's been happening is, really ugly here coming into the end of the month. Hasn't gotten much better here, but the kind of leading negative signal down here is not quite as bad over here. If I go to a little bit shorter time frame, a little bit more detail, you see 3C moving a little bit more with price, especially as we get into this area over here. Over here we have some sharper divergences. That's like heavier selling right into the close. Same thing over here, heavier selling, and then price comes down. So 3C has the power to contradict price, and it's basically helping us forecast where it's going to go. But my point here is just very low conviction. The bulls really didn't step up a whole lot this week. Didn't see much short covering at all. You might recall I showed you this chart last week. S&P 500, the white line, is my most shorted index of stocks. And I was saying, look, the shorts have been all over this thing since that key reversal day. But that can also be a contrarian signal where sentiment is just a little bit too bearish. You can see over here this week just not much short covering, so there's a lot of potential here for a short squeeze in the short term. I did think it was really interesting where the S&P did find that support on the heavier volume at the week's lows. This is our bear market of 2022. Here's our lows, our bases in October, and this has been the rally ever since, an intermediate uptrend. And you can see the trend line here. And if we zoom in close, that's where the S&P found support right at the middle of the week with that hammer. So that's obviously an important level, and right now it's right up here around 4,300. Remember, I was telling you on an intraday basis, 4,300's been a little bit sticky, so it's an important level to be paying attention to. For our members, this is the stuff I do all day, intraday, so I pointed out we did get a little bit of some buying. Like I said, not really strong, heavy conviction, but we did see some buying, so I'll show you where. So here we're looking at QQQ on 3C. You can see negative divergence here. You can see a leading negative divergence, really ugly, right over here. And as we come into the low of the week, we have a slight positive divergence. And if I zoom in closer, specifically to Friday, right here, actually, before I do that, let me show you something on the S&P's chart. But we're looking at this area of the low Friday afternoon right here. So let's go and look at the S&P's intraday chart. And the reason this is interesting was because I was telling members before price came down, price was just selling off from the open. I said this little trend line right here, if price holds there, that could be interesting because this could be the start of a little bullish consolidation off the week's low. Wouldn't you know it? Price held right at that trend line. You can see where I drew it from, these 2 points over here. This is just really typical stuff of price action, how it works. But in any case, there's 4,300 again, that troublesome level. But there's that support around 230 or so. So let's go back to QQQ's chart. And let me zoom in. And right there, 230. So there's the buying right there that on the S&P chart was support at that little trend line. So we did see a little pickup in some buying late in the afternoon on Friday as we move into next week. Here's small cap IWM, the only other major average to close, just barely green on the week. Same thing, a little positive divergence right there and kind of leading. And if we step back a little bit and we look at a 2-minute chart of IWM, here is the high, the head and shoulders high, right? And you can see 3C really negatively diverging. Over here, price is confirming on a little consolidation, but over here again, negatively diverging. Here, leading negative, so it's a leading price. Price hasn't really fallen at this point, but it leads price lower. What I'm seeing over here is a little bit better tone in IWM as we ended the week. Another little interesting thing, if you watched the end of last weekend's video, I said, look, semiconductors are leading the tech sector lower coming into this past week. The tech sector had not traded down to that head and shoulders neckline, but semiconductors were sending the signal that it would, and it did. This week we have the opposite. And what you're looking at is the technology sector in the candlesticks, bear flags, price moving lower, and the semiconductor index, SOX, the Philly semis in blue. So over here you can see a bear flag and semis are leading lower. Price moves lower. Over here another bear flag and semis are leading lower. This is what we saw at the end of last week. Let me go to a 5-minute chart to see, or rather to show. And I didn't say it, but the chart is normalized from the left side over here, so prices start at the same. Again, tech sector and semis leading lower. Coming into the week over here, you can see semis are leading tech lower. Tech comes down to its neckline right here. But look at this, on Thursday at the open, semis all of a sudden start tearing and they're leading tech higher. So here's the same chart, but it's just normalized as of the start of this past week. It's actually a little bit before, but there it is. You can see semiconductors are leading tech higher. So that's a bullish signal. These are a lot of the things that we look for. It's not just about the price action, although that's the most important thing. It's not just about the indicators, but it's about relative performance of different groups. Semis are much more economically sensitive than the broader tech sector. They tend to lead it. Same thing with Dow Transports versus Dow Industrials. Same thing versus small caps against the S&P. Going into next week, I think there's a pretty decent chance we get a little bounce. For stocks to really get some upside traction, yields are going to need to come down. I think the 10-year yield below 4.5% would be great for stocks to get some upside traction, which is what I want to see because I want to sell short into them. But I don't want to chase prices lower. I want to sell into strength. By the time I did this video, so Congress just passed the stopgap legislation Saturday night. They avoid the shutdown of the government at 12:01 a.m. Sunday, and they kicked the can down the road till November 17th. So maybe that's a reason for stocks to rally into next week. What I'd like to see, and this is a 2-hour chart of the S&P, and there's our head and shoulders. It's already broken, kind of back test it. What I would like to see is price maybe to trade up into this gap up here around 4,400. Ultimately, the higher the better as far as getting in at a better short price. It's like buying a stock. You want to buy low and then you want to sell high. Short selling is the same thing, just in reverse. You sell high first and then you try to buy back low. So if we could come into next week and maybe come up here, get a little bit of trouble just because that's a neckline. It'll probably act as resistance for a little bit and then come into this gap. Now, we could completely fill the gap and that's fine. If we leave that gap open even just a little, that is a bearish development. It's a bearish breakaway gap. We have one of those from the head of this pattern that is still wide open right after that Q reversal day. So that's even more bearish. But this is what I'd like to see is kind of a bounce up into this 4,400 area. If we can get a little bit more than that, great. And by the way, jumping back to this 2-hour chart, that's the bearish breakaway gap that's never been filled. Didn't even get close to getting into that gap, and that happened right after the key reversal day. So we have another gap here, and that's what I'm kind of hoping for, that we get up into that gap next week. And since we have our strategic outlook with the economy, with what I think the market's going to do, we have these head and shoulders tops. You know, it's just all about executing a plan right now, and a little bounce like this would help us do that. So I hope you enjoyed this video. If you did, please give it a thumbs up. Please give it a like. If you have other people that are interested in this stuff, please feel free to share it and check out the website. There's not much time to subscribe at 2008 rates at Wolf on Wall Street Trade until we transfer over to the technical take.net. That may happen as early as this weekend. I don't know. It's been a lot to get this website going, but that's going to be happening soon. And a lot of great new features with the website, Discord, chat room. It's going to be awesome. So everybody have a fantastic weekend. Thanks for sticking with me on this video. And members, I'll see you all on Monday.